Hello guys, welcome to Financial Tidbits. I am Ketan Upasni and today we are going to talk about inflation. Inflation is the rate at which the prices of goods and services increase over time. We must have heard a lot of stories in our home that back then things were a lot cheaper and now they have become very expensive. Why? This is the effect of inflation. So to put things under perspective, in 2022, India's inflation rate was 7%, whereas the global average was 2.9%. What does this mean? This means that a commodity which was priced at rupees 100 in 2021 was priced at rupees 107 in 2022. That is the 7% rise in prices, which we call inflation. Now, what are the causes of inflation? There are many factors that contribute to inflation, but there are three major important causes of inflation. The first one is the demand pull inflation, the second one is the cost push inflation, and the third one is the built-in inflation. So let us go through it one by one. What does demand pull inflation mean? This occurs when the demand for goods and services exceeds the supply. So it is basic economics that when the demand for goods is higher than the supply, the prices of the commodities increases. Hence, this is called as demand pull inflation. This can happen when the economy is growing rapidly and there is more money in circulation. So we can relate that to India. As India is growing very rapidly and there is more money in circulation, there is a demand pull inflation. The next one is the cost push inflation. This occurs when the cost of producing goods and services increases. So when the raw material prices of a commodity increases, this rise in prices of raw materials is passed on by the seller to the consumer through the price, and hence we have to pay more for the same exact good. This can happen due to factors such as rising wages, higher energy prices, or supply chain disruptions. Moving on to the next one, the built-in inflation. This occurs when people expect inflation to continue and they raise their wages and prices accordingly. Now, let us understand the impact of inflation. So, inflation can have a number of negative impacts on the economy and on people. Some of the big impacts are reduced purchasing power. When the inflation is high, we cannot buy the same quantity of goods in a given amount of money. As I explained in the previous example, the thing which used to cost 100 rupees now cost 107 rupees. So our purchasing power is actually reducing. The next one is uncertainty and instability. Inflation can create uncertainty and instability in the economy. This makes it difficult for businesses to plan for future and can discourage investment. So this is another important point and a negative impact that we face because of inflation. The third one is increased inequality. Inflation generally widens the gap between the rich and the poor. This is because high income earners are better able to afford high prices while low income earners are more likely to suffer. So this is another big impact of inflation on people's lives. Moving on to the next one, inflation in India, recent trends. So as explained earlier, in 2022, India's inflation was 7%, whereas the global average was 2.9%. So India's inflation rate is significantly higher than the global average. There are a number of factors that have contributed this rise in inflation in India. These include rising food and fuel prices, supply chain disruptions due to the COVID-19 pandemic, and the actual COVID-19 pandemic affecting the way businesses used to work and causing additional difficulties in conducting business. So the inflation is expected to come down gradually and is expected to be around 4% in 2025. Moving on to the next topic, government measures to control inflation. Let us understand what government is actually doing to control the inflation. So some of the steps the government is taking are monetary policy measures. The RBI has raised interest rates in an effort to slow down the economy and reduce demand pull inflation. So when RBI increases the interest rates, more people deposit their money into the banks. That means that the money in circulation reduces, the disposable income which is actually spent reduces, and hence the demand pull inflation, whereas the demand is higher than the supply, this does not happen and this is controlled. Other thing which the government is doing is the fiscal policy measures. The government has increased taxes and reduced spending in an effort to reduce the amount of money in circulation. By increasing the taxes and reducing spendings, there is less money in circulation and hence again less spending, which controls the inflation. The third one is the supply side measures. The government has taken steps to increase the supply of goods and services. When government helps and the supply of goods and services actually increases, then the demand supply gap does not remain wide, and hence the inflation or the rise in prices or the situation which we discussed earlier, the demand pull inflation, does not happen and the inflation is controlled. Coming to the most important question, what can individuals do to protect themselves from inflation? What can we do to protect ourselves? So the first point is invest in assets that tend to appreciate during the times of high inflation. So some of the examples are gold, real estate and stocks. When the inflation increases, gold prices, real estate prices and stocks go up. So this is a way we can earn money or hedge against inflation. The second one is reduce their debt burden. As inflation makes it difficult to pay the loans back, to repay the loans, it is recommended that you reduce the debt burden or don't take a loan altogether. The third one is increase the savings rate. When we know that the inflation is increasing, we can have more money to fall back on if the income is eroded by inflation, if we increase our saving rate. So that should be one of our priority. Investing in inflation index bonds can help us hedge against the inflation risk. So inflation index bonds are directly linked to the inflation rate and it goes in the same direction. That means if the inflation increases, the prices of inflation index bonds, the returns we get, also increases. Hence, that is a good hedge against the inflation risk. To the final part of this video, inflation is a complex phenomenon with a variety of causes and effects. The central banks and the governments plays an important role in controlling inflation through its fiscal and monetary policies, as we discussed earlier. However, we can also take our own steps to protect ourselves against the negative effects of inflation. Like we discussed earlier, we can invest in gold, we can invest in real estate, we can invest in stocks. Historically, if you see, the stock market has given a return of around 12% CAGR. That means we can use the stock markets to hedge ourselves against the inflation. We need to note that inflation can be challenged, but we also need to accept it as a normal part of the economy. There are a number of things that individuals can do to prevent the negative effects of inflation, and we need to be informed in taking the necessary steps, and we need to take action to make sure that we are hedging against inflation and we are making sure that the value of the wealth we create isn't going down but is increasing. That is the end of the presentation. Do like the video and subscribe to my channel, and let me know in the comment section what you think about it and what other topics you want me to make a video on. See you in the next video.